Hello and a very warm welcome. Today, we're getting into a topic that, let's be honest, sounds pretty scary. HMRC's power to take money straight from your bank account. It's something that brings up a ton of questions, but our goal today is simple: to give you total clarity on how it works, who it really affects, and, most importantly, what your rights are.
And we're able to walk you through all this thanks to the brilliant tax experts at My Tax Accountant. They're one of the UK's top accounting firms, and they've helped put this guide together to make sure everything you hear is spot on, practical, and completely up to date.
So, let's cut right to the chase. The big question: can HMRC actually take money directly from your bank account? The short answer? Yes, they can. But, and this is a huge but, the full answer involves a really strict legal process that's packed with safeguards to protect you, the taxpayer. And we are going to unpack that whole process right now.
Okay, let's dive in. First, we'll get clear on what these direct recovery of debt powers actually are. Then, we're going to walk through the exact journey HMRC has to follow, step by step. We'll look at who's most likely to be affected, and then the crucial part, the financial shield that's in place to protect you. And finally, we'll cover how you can fight your corner and where to go for expert help. Let's get to it.
All right, so first things first, what are these powers and why do they even exist? Well, HMRC brought them in to solve a very specific problem. People and businesses who owe tax, the debt is confirmed, they've got the money to pay it, but they're just not paying. This isn't about targeting people who are struggling and can't pay it. It's designed for those who won't.
The official name for this is Direct to Recovery of Debts, or DRD for short. It's a legal power that lets HMRC collect unpaid tax directly from your accounts. That includes bank accounts, building societies, and even your cash ISAs. But here's the thing you have to remember. This is an absolute dead last resort. It's only ever used after every other attempt to get in touch and sort out the debt has failed.
Now, this number is really important. It's the first of several big safeguards we're going to talk about. £1,000. HMRC can't even think about using these powers unless the tax you owe is at least £1,000. If your debt is any less than that, this whole process is completely off the table. So let's look at the actual journey, because this is not something that happens out of the blue. There's a very clear, legally required process that HMRC must follow. And honestly, understanding these steps is your best line of defense. As you can see, there are quite a few steps here. It all kicks off with HMRC trying to contact you multiple times. If they get no response, we get to what is probably the most critical stage, a mandatory face-to-face visit from an HMRC officer. It's only after that visit, if things are still up in the air, that they will send a hold notice to your bank. Now, this doesn't take the money, it just freezes it. From that point, the clock starts ticking. You have a 30-day window to object. And only if that window closes with no agreement does HMRC finally issue the deduction notice to transfer the cash.
So that's the process. But who does this actually happen to? It can all feel a bit abstract, right? So let's bring this down to earth with some real-world examples to see who's most likely to be affected.
A really timely and important example actually involves UK pensioners. Around late 2025, a lot of people started getting notices about tax deductions scheduled for December. And understandably, this caused a lot of worry. So let's break down exactly what's going on there and why. Many of the notices people are seeing mention a figure of up to £450. Now, let's be crystal clear. This is not a new tax. It's the maximum amount HMRC is allowed to collect in one go from certain pensioners to clear up old tax errors. We're often talking about small underpayments that have added up over a few years, sometimes without the person even knowing about them.
So who exactly is at risk here? Well, it's mainly people whose finances got a little more complicated in retirement. For instance, if you get both a state pension and a private pension, things can get tricky because the state pension is paid out before tax is taken off. Also, if you've worked part-time, maybe had the wrong tax code for a few years, switched pension providers, or took a lump sum that nudged you into a different tax bracket for a year, you could easily have an outstanding balance. On the flip side, if you just get the full state pension and have no other income, you're very unlikely to be affected by this. But it's not just about pensioners. Let's think about someone else, say a freelance graphic designer based in London. For anyone who's self-employed or runs a small business, cash flow is king. Getting a hold notice that freezes funds in your account would be a massive shock. It wouldn't just mess with your personal bills, it could literally stop you from paying your suppliers or covering your business costs. You can see how that creates a serious ripple effect. It just goes to show this can impact anyone with an established tax debt. Now, I know this all sounds pretty intense, but stay with me. The next point might surprise you. Because when this law was created, it wasn't just about giving HMRC more power. It was also about building in a really strong financial shield to protect people from real hardship. Let's look at those key safeguards.
So, here it is, the big one, the number you absolutely have to remember, £5,000. This is the minimum amount of money that HMRC is legally required to leave across all of your accounts combined. If taking the tax you owe would drop your total balance below £5,000, they simply cannot do it. End of story. This is, without a doubt, the single most important protection in this entire process.
And the protections don't stop there. On top of that £5,000 guaranteed, the debt has to be established, meaning it's confirmed and there are no active appeals against it. That face-to-face visit we talked about, it's mandatory. HMRC also has to check if a person is vulnerable and needs extra support. And for joint accounts, they can typically only take the debtor's share of the money. These aren't just suggestions, they are strict, legally binding rules.
Okay, so what if you get one of these notices and you think, hang on, this is wrong? Well, it's so important to know that you have the right to fight your corner. This isn't a one-way street. There's a proper, formal path for you to make your case. So you might be thinking, what if I've already paid this debt? Or what if the amount they're claiming is just plain wrong? Or what if, even with that £5,000 safeguard, losing this money right now would cause you exceptional hardship? Well, these are all perfectly valid reasons to object. The process kicks off the second you get that hold notice. You've got 30 days to send a written notice of objection to HMRC. In your letter, you need to spell out exactly why you're objecting. Be as specific as you can. Now here's a pro tip. Always get proof of postage, or even better, use a signed-for service. That 30-day deadline isn't for when you send it, it's for when HMRC receives it. Once they have it, they have to look at your case and get back to you. And if you're still not happy with their decision, your next move is to appeal to the county court.
Let's just quickly run through these deadlines again because they are absolutely critical. You have 30 days for your objection to get to HMRC. They then have 30 working days to get back to you, and if you need to take it further, you've got another 30 days from their final decision to appeal to the court. You really don't want to miss these dates.
Wow, we have covered a lot of ground, from the legal nitty-gritty to the safeguards and your right to appeal. So let's pull all that together now and focus on the key things you need to remember and what you should do if you ever find yourself in this situation.
So if you only take away a few things today, let it be these 5 points. 1. This power is real, but it's a last-ditch effort for confirmed debts. 2. It never, ever happens out of the blue. There are always warning signs, especially that mandatory face-to-face visit. 3. Your money is protected by that £5,000 minimum balance safeguard. 4. You have a legal 30-day right to object if something is wrong or it would cause you hardship. And 5, and this is probably the most important thing of all, act fast and communicate. Ignoring the letters is what leads to this stage in the first place. Okay, before we wrap up, we have to give our official disclaimer. The information we've shared today is for general guidance. Your own tax situation is unique and can be complex, so please don't rely on this information alone to make decisions. It's so important that you speak to a professional tax expert who can look at your specific circumstances. And for that kind of expert, one-on-one advice, you can get in touch with the team at My Tax Accountant. You can call them on 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk.
We'll leave you with one final question to think about. Now that you understand the process, the safeguards, and your rights, how might you handle a letter from HMRC differently? Hopefully, knowing all this has left you feeling a bit more empowered to tackle any tax issue with confidence. Thanks so much for joining us.